In this assignment, I will tell you about the Forex markets, Welcome to my TDFA video assignment. In this assignment, I will tell you about the Forex markets, about investing strategies, and about my technical analysis, so my trade in the Google stock. So I'll show you on TradingView. So I've chosen this topic because I've traded on the Forex market in the past. The Forex market has a lot of volume and a form of consistency in my view when it comes to trading the currencies. The Forex market has given me the opportunity to trade profitably in some way. So what is the Forex market? The Forex market also has the foreign exchange market, the FX, or just the Forex market, is an over-the-counter global marketplace that sets the rate for currencies around the world. Participants in this market can buy, sell, trade, and speculate on the relative exchange rates of various currencies. Currency markets consist of banks, forex dealers, commercial companies, central banks, assets managers, hedge funds, forex retailers, and investors, of course. The Forex market was one of the original financial markets formed to bring structure in the fast-growing global economy. In terms of trading its volume, it is by far the largest financial market in the world. In addition to providing a venue for buying, selling, exchanging, and speculating on currencies, the Forex market also enables currency conversion for international trade, settlements, and investments. Currencies are always traded in pairs, so the value of one currency in that pair is compared to the other value. This determines how much of country A can buy any of country B's currency, and vice versa. In the establishment of this relationship for the global market is the main function of the forward markets. This too increases liquidity in all other financial markets, which is the key to overall stability. The value of a country's currency depends on whether it's a free float or a fixed float. Free-floating currencies are currencies whose relative value is determined by free market forces, such as supply-demand relationships, of course. A fixed float is where a country's government determines the relative value of its currency against other currencies, often pegging it to a certain standard. Free-floating currencies include the US dollar, Japanese yen, British pound, while examples of fixed-floating currencies include the Panamanian balboa and the Saudi riyal. One of the most unique features of the Forex market is that it consists of a global network of financial centers that transact 24 hours a day and only close on weekends. While one major Forex hub closes in another hub in another part of the world remains open for businesses. This increases the liquidity available in Forex markets, adding to its appeal as the largest asset class available for investors. So then the types of markets. The first type is a spot Forex market. The spot Forex market is immediate exchange of currencies at a current exchange on the spot. This makes up a large portion of the total Forex market and involves buyers and sellers from across the entire spectrum of the financial sector, as well as those individuals exchange currencies. Second type is a forward Forex market. The forward market involves an agreement between the buyer and seller to exchange currencies at an agreed upon price at a set date in the future. No exchange of actual currencies take place, just the value. The forward market is often used for hedging. And then the third type, those are the futures Forex market. The futures market is similar to the forward market in that there's an agreed price at an agreed date. The primary difference is that the futures market is regulated and happens on an exchange. This removes the risk found in other markets. So futures are also used for hedging. And then the special thing in the Forex market is the leverage trading. The leverage available in Forex markets is one of the highest that traders and investors can find anywhere. Leverage is given to an investor by their broker, of course. With this, investors can increase their trade size, which could translate in greater profitability. A word of caution though, losses are also amplified. And then the advantages of the Forex market. So there are a few advantages, and these are the following. These are very important. There are fewer rules than in other markets, which means investors aren't held to the strict standards or regulations found in other markets. So that's very accessible. There are no central bodies that oversee the Forex market. Up to that, most investors won't have to pay the traditional fees or commissions that you would pay in another market. So it's, how to say that, cheaper, relatively. Because the Forex market is open 24 hours a day, you can trade at any time of the day, which means there's no cutoff time to be able to participate in this market, except the weekend, of course, like I said. Finally, if you're worried about risk and reward, you can get in and out whenever you want, and you can buy as much as currency as you can afford based on your account balance and your brokerage rules for leverage. But there are also some disadvantages of the Forex market. The leverage can help magnify profits, but can also lead to high losses. As there are no limits on leverage, investors tend to lose a tremendous amount of money if their trades move in the wrong direction. So it can be very dangerous. Unlike stocks that can provide returns through dividends and bonds, through interest payments, Forex transactions rely on appreciation, meaning they have less returns than some other assets. And the third one is the lack of transparency in the Forex market can harm a trader, as they do not have the full control over their trades when they're failed, may not get the best price, and may have a limited view of information such as quotes. So this was the overall perspective of the Forex market. Investing strategies. I've chosen this topic because I think it's very important to have certain strategies while investing. If you simply invest in different assets without a strategy, the money will probably come and go. If there's a strategy, you can build on that strategy to grow further. An investment strategy is a set of principles that guide investment decisions. There are a lot of investment plans you can follow depending on your risk behavior, investment style, long-term financial goals, and of course access to capital. Investment strategies are flexible, so if you choose one and it doesn't suit your behavior, you can certainly make changes. However, changing investment strategies come at a cost. Anytime you buy or sell securities, especially on short-term, taxable events can arise. You also may realize that your portfolio is riskier than you would think after your investments have fallen in value. So we're going to look at 4 common investment strategies that are suitable for most investors. But before you begin to research your investment strategy, it is very important to gather some basic information about your financial situation. So ask yourself the next questions. What is the current financial situation? And what is your cost of living, including monthly expenses and debts? And the third one, how much can you afford to invest, both initially and on an ongoing basis? Even though you don't need a lot of money to get started, you shouldn't start investing until you can afford to do so. If you have debts or other obligations, consider the impact investing will have on your short-term cash flow before you start putting money into your portfolio. Next, set out your goals. Everyone has different needs, so you should determine what are yours. Are you saving money for retirement, or are you going to make big purchases like a home or a car, or are you saving money for your children's education? This will help you narrow down a strategy, as different investment approaches have different levels of liquidity, opportunity, and risk. Next, figure out what your risk tolerance is. This is normally determined by several key factors, including your age, income, and how long you have until you retire. Investors who are younger, those have more time on their side to take losses. So it's often recommended that younger investors hold on more risk than those who are older. And then we have the strategies. The first strategy is value investing. Value investors are bargain hunters. They look for stocks that they believe are undervalued. They look for stocks with prices that they believe do not fully reflect the intrinsic value of the security. Value investing is based on, in part of the idea that there is some degree in the market. This in theory creates opportunities to get a stock at a discounted price and make money off it. Value investors don't need to sift through a large amount of financial data to find deals. The next strategy is growth investing. Growth investing, rather than look for low-cost deals, growth investors want investments that offer strong upside potential when it comes to future earnings of stocks. It could be said that a growth investor is looking for the next big thing. Growth investing, however, is not a reckless way of speculative investing. Rather, it involves evaluating a stock's current health as well as its potential growth. Momentum investing is the next strategy. This investing is like riding the wave. They believe that winners keep winning and losers keep losing. They try to buy stocks that are on an uptrend because they believe the losers will continue to fall. They may choose to sell those securities. Momentum investors rely heavily on technical analysis. They use a strictly data-driven trading approach and look for patterns in stock prices to guide their buying decisions. This adds extra weight to how a security trades in the short term. And then the last trading strategy, dollar cost averaging. The DCA is the practice of a regular investment in the market over time and is not mutually exclusive to other methods described above. Rather, it means to implement the chosen strategy. With DCA, you can choose, for example, to put like 300 euros into an investment account each month. This disciplined approach becomes particularly powerful when you use automated futures that invest for you. The advantage of the DCA strategy is that it avoids the painful and ill-fated strategy of market timing. Even seasoned investors occasionally feel the temptation to buy when they think the prices are low, only to discover that they still have a longer way to go fall. So, those were the strategies, but I think the decision to choose a strategy is more important than the strategy itself. Indeed, any of these strategies can generate significant returns as long as the investor makes a choice and commits to do it. So it's also about mindset, I think. The reason it is important to choose is that the sooner you start, the greater the effects is of the preparation. So I would say to the young investors, you do a good job. And then the last subject, the technical analysis. I was looking on this Google chart on the 1 hour time frame. I was first looking at the 4 hour time frame, but now I was zooming into the 1 hour because I saw a better pattern there. Risk management, I take a risk of 3%. I did the calculation like you told me to do, and my position size is like 1195. And I was looking at the chart, I saw this short. I see a downtrend, like I said, and I see the head and shoulders. So it fell down after the head and shoulders. Now it pulled back a little bit, and it touches the horizontal line and the trend line. And I think that's a big resistance because it was like a support in the past 2 times. So yeah, I think there is some resistance over there, and I think it will drop down even more from that point, based on head and shoulders and downtrend and the trend line and horizontal lines. So yeah, this is my trade, and I hope it will go in a good way. So this was my video assignment about Forex market, investment strategies, and my technical analysis. I hope you enjoyed it, and thank you for watching.